There is a very important question developing in the gold and silver market right now, and I think most investors are asking the wrong one. They are asking whether this latest rally is just a bounce after a brutal correction. I think the better question is this: what if the forces that pushed gold and silver lower are now starting to reverse? Because the market has already gone through something extraordinary. According to the source data, gold reached an all-time high around $5,602 per ounce on January 29th, while silver reached approximately $121.67 on the same day. Then the market turned violently lower. By July, gold had fallen toward $3,960, while silver had dropped toward $58. That was not a normal pullback. It was the kind of correction that makes investors question the entire bull market thesis. And this is where I want to take a different approach. As an independent macro analyst, I don't want to tell you that gold and silver are automatically going higher just because prices have bounced. That would be too easy. I want to understand what caused the collapse in the first place, because if those forces are now changing, the market could be entering a completely different phase. The first major force was monetary policy. The Federal Reserve became more hawkish, pushing expectations toward higher interest rates and higher real yields. That matters because gold doesn't pay interest. When investors can earn increasingly attractive returns from cash and bonds, the opportunity cost of holding gold rises. The source argues that this relationship was one of the major mechanisms behind the correction. But then something even more unusual happened. Geopolitical tension involving Iran did not initially produce the normal safe haven reaction investors expected from gold. Instead, the conflict pushed oil prices higher. Higher oil prices increased inflation concerns, and higher inflation expectations gave the Federal Reserve another reason to maintain a tighter policy stance. So we had a strange paradox. The geopolitical crisis that should have supported gold was simultaneously creating an inflation problem that was hurting gold. That is a critical distinction. It tells us that gold does not simply respond to war headlines. Gold responds to the entire macroeconomic chain connecting geopolitics, energy prices, inflation, interest rates, real yields, and the dollar. And then came the next major catalyst, the U.S. labor market. The source highlights the August 7th jobs report, where the economy reportedly lost 23,000 jobs in July, against expectations for an increase of roughly 80,000. That dramatically changed expectations surrounding the Federal Reserve and the possibility of another rate hike. That is where the market started to turn. Because when traders begin thinking that the Fed may not be able to keep tightening, real yields can fall, the dollar can weaken, and gold suddenly becomes more attractive. Silver can react even more aggressively. And that's exactly what the source describes. Silver moving from roughly $58 towards $64.10 by August 7th, while the gold-silver ratio compressed from around 69 to approximately 67. But here's the question I want you to keep in mind. Was that simply a short-term reaction to weak jobs data, or was the jobs report the first sign that the macro environment supporting the July collapse is beginning to disappear? Because if the Fed becomes less hawkish, inflation pressure eventually cools, and real yields continue falling, the environment for precious metals changes dramatically. And that is why I don't think investors should dismiss this move as just another dead cat bounce. The correction was real, the pain was real, but the underlying question is whether the bull market thesis was actually destroyed, or whether the market simply went through a violent reset before the next phase began. And that distinction could determine what happens next for both gold and silver. There were 3 verified forces behind this correction, and understanding them is the key to everything that follows. The first was the Federal Reserve's hawkish pivot. Here is the mechanism in plain terms. Gold pays no interest and no dividend. Your only return from holding it is price appreciation. When interest rates are low, gold looks attractive because the alternative, parking your money in bonds or savings, does not pay much either. But when rates rise, a bond suddenly pays you 4 or 5%, and gold, which pays nothing, looks a lot less appealing by comparison. This relationship is called the opportunity cost of holding gold, and gold has a well-documented negative relationship with real yields, which is interest rates adjusted for inflation. In early 2026, under Fed Chair Warsh, the Federal Reserve pivoted hard toward a hawkish stance, meaning tighter policy and higher rates for longer. That pushed real yields up, and as real yields climbed, gold fell. This is not correlation, it is a direct mechanical relationship. The second force is what I call the Iran paradox, and it is genuinely counterintuitive. Normally, geopolitical tension sends money into gold as a safe haven. But in 2026, the escalation of the US-Iran conflict pushed oil prices sharply higher, and higher oil prices lifted inflation expectations, because oil feeds into transport, manufacturing, food, and energy costs across the board. Rising inflation expectations put pressure on the Fed to stay hawkish or even hike further, which kept real yields elevated, which kept gold under pressure. So the same conflict that should have supported gold as a safe haven ended up working against it because it was simultaneously feeding the inflation problem that hurts gold. That is a subtle but critical point, verified across multiple macro research desks. The third force is simpler, profit-taking. When any asset gains 60% in a year, or in silver's case, 147%, large institutional funds eventually lock in gains. This is not panic, it is routine risk management after an extraordinary run. There was also a clear signal from the Shanghai Gold Exchange, where the premium Chinese buyers were paying over Western prices, which had been running near $72 an ounce, flipped into a discount. That told traders that some of the intense Chinese demand fueling the rally was pausing, and the correction deepened from there. So three forces working together: the Fed's hawkish pivot lifting real yields, the Iran conflict paradoxically feeding inflation instead of fear, and institutional profit-taking after one of the greatest precious metals rallies in decades. That combination is what drove gold down 28% and silver down 52%. Now here is where most of the dead cat bounce callers get it wrong. The same mechanism that caused the crash is now running in reverse. And the reversal did not start with a central bank speech or a ceasefire announcement. It started with a single data release at 8:30 in the morning on Friday, August 7th, 2026, the U.S. non-farm payrolls report. One of the most closely watched releases in the world because employment sits at the core of the Federal Reserve's dual mandate of maximum employment and stable prices. Economists had expected the U.S. economy to add 80,000 jobs in July. Instead, verified data from the Bureau of Labor Statistics showed the economy lost 23,000 jobs, the first outright decline in months. The unemployment rate slipped to 4.1%, but that was misleading because labor force participation fell to 61.4%, its lowest level in over 5 years, and prior months were revised sharply lower too. Wages fell. Every component of the report pointed to a labor market cooling far faster than anyone expected. The moment that jobs number hit the wires, traders immediately began repricing the odds of a Federal Reserve rate hike at the September meeting. Before the report, the market had priced in roughly a 67% chance of a hike. As of the most recent verified reading this week, that probability has fallen to around 44%, according to CME Group's tracking tool, which measures live market bets on Fed decisions. That is a massive shift in a matter of days, and it produced a direct mechanical effect. Real yields fell. The US dollar dropped to a 2-week low against major currencies, and gold and silver both moved sharply higher. Gold broke above $4,300 and has continued climbing, trading around $4,380 per ounce as of this week, up more than 9% over the past month and roughly 31% higher than this time last year based on verified exchange data. But the real story is silver. Silver surged from around $58 at its July low to the mid-$60 range, touching a 7-week high near $66 per ounce this week. The gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, compressed from around 69 to 1 at the start of last week down to roughly 67 to 1. That compression matters because historically, when silver outperforms gold, it signals the metals are entering an accelerating bull phase, not a dying one. Now let us deal directly with the dead cat bounce argument. A dead cat bounce is a term from Wall Street describing a short-lived recovery inside a longer downtrend, the idea being that even a dead cat will bounce if it falls from a high enough floor. People making this argument say this rally is just a blip, that prices will resume falling once the jobs data fades from memory. It is a reasonable argument on the surface, but the verified data does not support it for 3 specific reasons. The first reason is that the structural bull case for gold was never actually broken. Central banks, the most sophisticated long horizon buyers in the world, bought 244 tons of gold in the first quarter of 2026 alone, according to the World Gold Council. These are not emotional retail decisions, these are multi-decade national wealth allocation decisions. The annualized pace of central bank gold buying is running between 750 and 1,000 tons per year, according to UBS research. That level of structural demand does not reverse because of a 6-month price correction. There is also a verified development from the European Central Bank, which confirmed in a June 2026 report that gold has now surpassed U.S. Treasury bonds as the world's largest reserve asset. For over a century, Treasury bonds were the bedrock of the global financial system. That has now changed. That is not a small shift, that is a tectonic one, and it does not get undone by a 28% pullback. The second reason is the silver supply situation. The Silver Institute, the primary research body tracking global silver supply and demand, confirms that 2026 will mark the 6th consecutive year of a structural silver supply deficit, meaning the world is consuming more silver than it is mining. This year's shortfall is projected at 46.3 million ounces, up from 40.3 million ounces in 2025. And this demand is not speculative, it is industrial. Solar panels, electric vehicles, and AI data center hardware all require silver, and none of that demand pauses because financial markets got nervous. In fact, recent trade data shows Chinese imports of silver-bearing ore surged 62.5% year-over-year in June alone, reaching 219,000 tons, direct evidence that industrial demand is accelerating, not slowing. The third reason this is not a dead cat bounce is the most important one intellectually. The correction between January and July was never caused by a problem with gold or silver themselves. It was caused by external forces, the Fed's hawkish stance, the Iran conflict feeding inflation, and normal institutional profit-taking. And every one of those three forces is now measurably easing. The August 7th jobs data is directly reducing the Fed's justification for further hikes. On the Iran front, talks between Iran and Oman are reportedly close to an agreement. And while Iran has publicly denied direct negotiations with Washington, U.S. officials have suggested a deal may be near. If that materializes, oil prices ease, inflation expectations soften further, and the remaining rate pressure on metals fades even more. And institutional profit-taking is by definition a one-time event. The funds that sold near the top have already sold and are now watching for re-entry points, rather than preparing for more selling. The forces that caused the crash were temporary and mechanical. The forces supporting the structural bull case are permanent and structural. Those are two very different things. Now let us look at what the major institutions managing the world's capital are actually forecasting, based on verified published research. Goldman Sachs holds a year-end 2026 price target for gold of $4,900 per ounce. Bank of America's 12-month target sits at $6,000. Bank of America analyst Michael Widmer has flagged three underappreciated risks: uncertainty around Federal Reserve leadership, structural fiscal deficits in the U.S. government's budget, and the fact that institutional gold allocations remain historically low. That last point matters a lot. Despite this extraordinary two-year rally, the average allocation to gold among major pension funds and endowments is still well under 5% of total assets. If even a small slice of that capital moves toward historical norms, the resulting demand would be enormous. UBS describes the structural gold bull market as fully intact and expects central bank buying to continue in that 750 to 1,000 ton per year range, with their most bullish scenario placing gold as high as $7,200 per ounce, if geopolitical risk escalates further. The World Gold Council places gold's fair value estimate at approximately $4,100 per ounce. With gold currently trading above that level, sentiment and momentum are clearly doing real work on top of the fundamentals, which is itself a sign of returning confidence rather than pure mechanical repricing. On silver, Commerzbank is forecasting $90 per ounce by the end of 2026. The London Bullion Market Association, which represents the world's largest bullion banks, published an analyst survey with an average 2026 forecast for silver of $79.57. Bank of America has even modeled a bull scenario for silver stretching between $135 and $309 per ounce if physical shortages intensify further. These are not base case numbers, but the fact that a major institution is running scenarios at that level tells you how seriously the structural deficit story is being taken at the highest levels of finance. So where does that leave us right now, with gold trading around $4,380 and silver trading in the mid-$60 range? We are sitting at an inflection point, and there are three specific verified signals worth watching closely in the weeks ahead. The first is the Federal Reserve's September decision. As of this week, the market is pricing roughly a 44% probability of a rate hike in September, already down sharply from 67% a week earlier. If upcoming inflation data and the next jobs report continue to soften, that probability could fall further, and every percentage point that comes off the hike odds adds upward pressure to gold and silver. If September passes without a hike, the mechanical tailwind for metals continues. If the Fed surprises with a hike, that would put renewed pressure on prices. This is the single most important near-term variable for where gold and silver go next. The second signal is the Iran negotiation. This situation remains fluid, with talks reportedly progressing through Oman, even as Iran denies direct contact with the U.S. If a deal is reached and Iranian oil exports are restored through the Strait of Hormuz, oil prices would likely fall, inflation expectations would ease with them, and that would weaken the Fed's justification for staying hawkish. That is direct fuel for lower real yields, which is directly bullish for gold. Watch this negotiation closely because it removes one of the three forces that caused the original crash if it resolves. The third signal is the technical level: $4,500 for gold and $70 for silver. These are not arbitrary numbers. They are levels where significant historical selling pressure has clustered on the charts. A confirmed break above these levels would trigger buying from trend-following funds, systematic investors who buy assets that are moving higher, which can create a self-reinforcing reinforcing rally as new capital confirms the trend, and the trend attracts more capital. Three signals to track: the Fed's September decision, the Iran negotiation, and gold clearing $4,500 with silver clearing $70. You do not need to watch every headline every day. You need to watch those three things. Gold dropped 28%. Silver dropped 52%. The reasons were specific and mechanical: a hawkish Fed lifting the cost of holding non-yielding assets, an Iran conflict that paradoxically fed inflation instead of fear, and institutions taking profit after one of the greatest precious metals rallies in modern history. Then, on August 7th, 2026, the jobs data flipped the equation: 23,000 jobs lost instead of 80,000 gained, and rate hike expectations collapsed, real yields fell, the dollar weakened, and gold and silver moved sharply higher in direct response. The structural case: central banks buying at record pace, silver in its sixth consecutive year of supply deficit, and gold now surpassing treasury bonds as the world's largest reserve asset, was never touched by any of that. It was intact the entire time. This bounce is not a dead cat. It is the market remembering why it bought gold and silver in the first place. If this breakdown gave you real clarity, share it with someone who bought near the highs and has been questioning everything since. They do not need reassurance. They need the framework to understand what actually happened and what to watch next. This has been Macro Bullion. I am Alex James. All figures here are drawn from verified sources, including the World Gold Council, the Silver Institute, CME Group, and major bank research. Markets move fast, so always check live rates before making decisions. Do your own research, and I will see you in the next one.